Okay, good afternoon, everybody. Welcome to the monthly or the weekly, I should say, Take on the Market. I will be your host. My name is Scott St. Clair. I am the Premium Product Coach here at Investors Business Daily. See if I can get this right. All right. Here's the disclaimer. Take a moment to look at this. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Our core competence, our circle of competence is research, education. So we'll talk about the markets, industry groups, stocks to watch, and then the quote of the week, the usual suspects. So let's jump right in. Let's pull up the, I think what I'm going to do is pull up Investors Business Daily. So today was a follow-through day on the market. So they're now in a confirmed uptrend. The Russell is up 3.2%. Volume spike today was enough to force a follow-through day. Investors should know volume had been running lower prior to the final minutes, but they had a rebalancing today. So it is what it is. It's a follow-through day. The main thing, the key to me is there anything to buy? In the last few follow-through days, there hasn't been a lot to buy. This one there were some possibilities, and we'll get into some of those. Let's pull up the indexes. So here's the NASDAQ, and that volume is huge, so that would qualify for a follow-through day on the NASDAQ as well. So this is the undercut, start the count over. This is the first blue day, that's day one. That's day two, that's day three, that's day four. This was not a follow-through day yesterday because the volume wasn't up from the previous day. But today you were up 3% and change, and the volume was higher. So you have a follow-through day. Again, I don't know if this one's going to work. I'm almost always, that I can recall, bearish or negative on follow-through days after long protracted bear markets, because a lot of them won't work. So, but one will, and it's asymmetric trade. I'm going to risk a little to make a lot. And I can do that, 4 or 5 times and get it right. Hopefully, this is probably like the third follow-through day, I think, maybe the fourth one. Let's look at the S&P and see a really strong day, up 3%. And the volume is tracking high. I can't say I'm surprised at all. I wish I'd handled a little bit better and been more long, because I had a feeling the market would rally, right? We talked about some of the divergences. ARK didn't make a new low when the markets did, and the bond market finally stopped, going down. So when the market was making new lows here, the bond market stopped going down, and that was kind of a straw that was stirring the drink. So I don't know if this one's, like I said, I really don't know if this one's going to work. I'll put on some longs and I'll try it, and I'll risk a little and see if we can make a lot. Let's get into some of the slides that I had. It's been a really bad bear market. I know it hasn't, from a time standpoint, been that destructive or like the S&P. I know the S&P maybe is, I think, high to low, maybe 25%, and the NASDAQ a little more than 30. So that's not unusual. That's typical. But with the combination of the bond market and stocks, so this is a telling chart. Now, not inflation adjusted. There's you're coming from higher numbers than in the 70s and 80s, but you get the idea. It was a really nasty move down, and I'm not even going to get into the whole crypto thing. the destruction of wealth there as well. So you've had a lot of damage. I think you've had more than enough damage to qualify for a good to severe bear market, whatever that might mean. Here's a chart from Tobias Carlisle that he tweeted. And you've got the start date, the end date, the duration of bear markets, the magnitude. So you can see the average bear market is 43 months long. The median is 24, 2 years. The magnitude and median are very similar, 40%. So this would be on the low end in both of these, both duration and magnitude. This is measuring the indexes, right? The indexes have done a great job of masking the underlying weakness. I could probably spend a whole video just off the top of my head naming stocks that have gone down 50% or more. PayPal, Shopify, Teladoc, Zoom, Carvana, Vroom, just so many SPACs that have gone down 50% or more. MicroStrategy, Riot Blockchain. There's just so much. DraftKings, all of the memes and the those types of stocks have all given back the gains and then some. So Netflix, Facebook, or Meta is down a lot. So it's been pretty nasty in most stocks. It's actually, I don't know, I'd love to, maybe one day I'll dig into the indexes and just kind of go through all 500 stocks and do a study on it. But it's like almost amazing. It's very strange to me that the S&P has held up as well as it has from a mass standpoint. It also had some stocks in there that have gone up, right? A lot of energy stocks, Exxon, things like that have actually gone up this year. And most people, I don't know about most, but a lot of people weren't in those names. So they were, from a growth stock strategy, it's been pretty nasty. I found this very interesting from Wall Street Journal that Facebook, Netflix, and PayPal are value stocks now. They've gone down so much and their metrics qualify as value stocks that they're being rebalanced into the Russell 1000 and they're balancing in the Russell 1000 growth index will be reduced. There are some stocks that can be in both indexes. I know Apple and Microsoft have been in a bunch of indexes for a long time. I don't know if that's a good thing that they're value stocks. I find that might just mean that they go sideways for a long time, and they're more market weighted performance. So if the S&P goes up 20%, they go up 20. If the S&P goes up 5, they go up 5. I just don't see them as outperformers. But who knows? We'll see. We'll see if they can kind of get their mojo back. But mostly, if you go back and study history, and I've got thousands of charts, and I look at them a lot, and it's amazing to me, some of the names, like, oh, I remember that name, it's gone. I remember that name, it's gone. I remember that one, it's gone. I don't know if they went away, went bankrupt, got bought out, merged with somebody, but they no longer exist. So you can go sideways for a long time. Xerox was a company that was the leader in the 60s and 70s. What did you do when you made a copy of something, right? I'm old enough to know you didn't copy something, you Xeroxed it. And I think I looked on their stock, if you've owned that since, maybe we'll pull it up. I think you'd had to have owned it, not including dividends, but you'd had to have owned it prior to like 74 to be still up on the stock. Any purchases after 1974 are sideways to down. So that's a long time ago. It's just dead money if you're lucky even to be sideways on the stock. All right, so let's pull up the industry groups. Energy coal still number one. Oil and gas is littered with them. Now, maybe we'll pull up here what I want to look at. Xerox, and I also want to look at the energy ETF. I think it's XLE, because they really got hit super hard. I think it was like one of their worst drawdowns in a short period of time in history. So, but they're up here for a reason, because they've been, top ranked for a while. Now, if this rally is real, I think these are going to move their way down, and some of these other ones will start to move their way up. I don't know, and I'll do a big search. This one thing about this for sure is you really should do a really thorough routine this weekend. Get prepared in case this is real. What if it is? What if it's the bottom of a super new bull market? I don't know. It could be. It could be. Why risk it? Why stick your head in the sand and say it can't be? Even if the odds are 5, 10, 15, 30% that's the case. There could be plenty of money to be made, even if it's only just a short-term swing. I remember in the 2000 had some incredible rallies, 30, 40% index rallies, where you definitely could have made some money in those type of rallies. So you definitely want to be doing some work looking for where the performance is coming. It seemed like healthcare. There's been some biotechs, some tech stocks are trying to come off the lows, things like that. If that's kind of your favorite fishing pond. But the oil and gas group looks tired at best. They all need bases. So there's not a whole lot here on the industry groups as we sit here. Let's pull up some stocks. Let's go to XLE. I think that's the one. Yeah. So 23% in, if you're counting the first week off the high, that's 3 weeks. If you're not counting that, right, then it's down almost at least 20% in 2 weeks. And they've all got hit really hard. PXD, Exxon even, which is a big portion of that XLE. What else? Devon, how's that? Oh yeah, it looks tired to broken. It's really amazing to me, and it's you have to stay on top of this market. It's tough, but this went from new highs to 40 week in 3 weeks. 3 weeks you went from everything is okay to 40-week line. And if you're willing to give back that type of gain, if you bought it way down here and have a big gain, okay, but that's a quick 30% in a short period of time. Really tough to stomach. So you better, you always have to kind of be prepared for, anytime these stocks nowadays can switch, which is why maybe it's a switch the other way. Maybe the money to fly out of here and go into some other stocks. It's the hard part is going to be finding them, because the relative strength won't be all that good. Like, let's look at CrowdStrike. So the relative strength is 39. So it would have to kind of be something that you've been aware of, that you've been watching, but maybe you just love it so much and know the business so much, you buy it breaking above the 50-day. I don't know. It's not a terrible buy point. It's not the best buy point, but it's not a terrible one. Zscaler, not quite as good. What else is, and you can see the group is 119, so way down the food chain. Some biotechs like Vertex, is that a biotech? Yeah. I did not see this. I wish I had. I think I would have bought that yesterday. That's pretty, I like that pattern. It's a pretty good pattern. And if you go to the weekly, that looks really good. That's a strong pattern. Now the relative strength is very good. It's not quite new high, but that's okay considering where the market's been. But and I've made money in Vertex before. It's been a pretty good stock. I think it was in this time period. So that was one that had a nice strong breakout. UTHR, I don't know how that did. Looks okay, coming out of a long base. You can see biotech is 71. Let's jump to biotech. I'm curious if, so 3 months ago it was 146. last week it was 85. Currently it's 71. So, that's the kind of change I like to see. Now, biotech is the biggest group as far as the number of stocks. So we go to stocks to group and click this button, show all component data. And then it's going to sort these based on EPS and RS rating. There's AMPH, which failed miserably. I got stopped out of that one, breaking out here and stopped out the very next day. But Vertex, ALKS, and you can just kind of go through this list and maybe catch some ideas. Wow, I didn't realize it was that many, 808 stocks. But this is pre-sorted, so 808, I'd probably go to maybe 40 or 50. I don't know if maybe even not that many. If you can't find anything to buy in the first, 30 stocks or something, you're probably stretching a little bit. So that's one way you could do some work to generate ideas. Before I forget, let's look at Xerox. I'm just curious. So, and we can't see it, but you can see Xerox is currently 1579, and there's probably some splits in there. So I want to be based on this chart. There's pretty much nowhere that you could have bought this stock and be up. I don't know what the dividend is, but forget all that. There's very few people that bought this stock in the last, 26 years that are up. Very, very few. There might not be any. It could be possible that there aren't any. Let's go back to 2000. Actually, it was a pretty good stock. I didn't realize, from the 90s, it went from 8 to 60. That it actually, I don't remember trading Xerox in that time frame, but actually it was a pretty good stock. But then once it broke in 2026, you can see here again, you've got a bunch of people here that have a double, but if I fast forwarded to 2003, now we're pretty much below all this, and there's just, again, by 2003, if I go back to 1975, there's very few people that have a gain in this stock, and we all dream of holding Apple and Google and set it and forget it, and Amazon, and those are needles in the haystack. So I commend anyone that's ever done that. They're great stories when you see that, so and so bought Amazon and he's up 37-fold in it or whatever. I think it's great. I'm envious. I wish I could do that. I just find that I've tried and they just come back. They all just come back. The ones that I've held, there always be a period where they come back. So I think you want to have some type of sell strategy. In fact, I know you want to have some kind of sell strategy for individual stocks. Buying mutual funds and really diversified ETFs, just buy till the cows come home, like in my 401k. Every month or every 2 weeks, I presume, when I get paid, a little bit of money goes into a mutual fund. And I don't even look. I don't even know. And I think I do know that my HSA, which is invested, is down 9.8% this year, because I had to go into my HSA the other day and look. So that's part of that chart, the bond / stock destruction, because I think it's like a 70-30 weighting. I think I'm like 70% bonds, 30% equities in my HSA, something like that. I don't even remember. It's not a whole lot of money, but I hate to just sit there. I don't know why it's doing that. Anyways, but I'm down 10%. I didn't even realize. So but I just in 401k, I'll just keep contributing, and just keep doing that over and over and over. And then maybe you can tweak your allocation as you get older. I think that's a smart thing to do. But if you're young, I would just pound the equity side. Just hope that this is a huge bear market. You probably could set up your 401k for life if it just kept going down and down and you stayed the course. You just kept buying at ever lower prices. But individual stocks, I just think you have to have a plan. I don't know, maybe I was brainwashed by Bill's book, but this is one of the very first books I read, you know, he talks about selling, and it made sense to me. And then when you study it and go through history, look at some of your old trades. You know, almost every stock I've ever sold is a lot lower than where I sold it. There are a tiny number that are significantly higher than where I sold it, right? And those are the ones that we remember, we think about, like NVIDIA or Google or Amazon, because he's like, oh, why didn't I keep that one? Well, it's hard to know. It's hard to know which one's going to be the next Google, the next Amazon. So you might want to consider that when you're how you're going to attack, you know, individual stocks. Anything else? So there are what else is kind of coming off the lows? Let's look at like Microsoft. Let's look at some of these big boys. So, you know, this red line has become the ceiling, this 10-week line, and you're still under the 40-week line. So I don't know. In fact, I wouldn't short Microsoft coming into that line, but that's normally a place where you might consider it. Like if you had done that this whole way up, you probably would have had a losing trade there. But almost every other one, you could have taken, you know, 5, 10, 12% if you're trying to do something like that. So, you know, this big liquid, I just think a long sideways time for these names. Let's look at Amazon. Again, right there. So once it breaks below that line, this is turning down, which tells me you're in a bear market for this stock. It's below the moving averages. It's right there. You know, if I get bearish, if the market starts to waver, these are the ones I'm going to go to quick. Amazon's not getting bought out, so I don't have to worry about that. It's liquid. I don't have to worry about liquidity. If I'm wrong, I'll be able to get out at my price. So these are, you know, I think that it's hard to tell right here. I actually have one short and a number of longs. Tesla couldn't quite get to the line. So maybe it has higher to get to the line, or maybe it's that much weaker. This is the one stock that I'm still short. Maybe I'm being stubborn. You know, obviously I wish I'd covered down, you know, 80, 100 points ago. I think it might have, I think for a brief moment, it might have broke 600, but I like having a little bit of balance. You know, I've got some longs, I've got a single short, and we'll see. Well, the market will tell me where I'm wrong and where I'm right. What else? So Apple, of course, again, couldn't, you know, not quite there. You know, that's almost, you know, that would be your target. You know, I actually hope it gets there. In fact, I probably will short Apple if it gets there, because one, I'll still have my longs, hopefully, because Apple's still good, strong. Two, I might have even more longs, so it might, you know, I might be 80% long, 10% short with Tesla. I might want to go 80-20, and you know, and then see what happens. So you know, I think that would be the ideal setup if it can get there. I think they're going to announce earnings. Oh, we're still a month away, so you know, there's no kind of gap up catalyst. So I'm on the fence. The market's telling me that it's in an uptrend, so I have to respect that. There isn't a ton of stuff to buy, but there is, you know, stuff that's acting good. I was surprised at how strong Vertex looked. This stock, medical products, tried to get above the 50-day, couldn't. But this, you know, this is huge gap up. Look at these numbers. It's incredible. I mean, 97 cents versus 5,000%. Look at the revenues, 1538, 126, accelerating like that. So this is very intriguing to me. That's, you know, it could just be trending. Maybe it's gonna, you know, it's kind of trend like that. If I were to draw like a channel line, it's just kind of thinking out loud. If the market's good, maybe it does something like that, and I can sell it at 100. 62 to 100 is a pretty good trade. In fact, that's a fantastic trade. So that's the asymmetry I'm looking for. I'll risk what's 7% on 62, was roughly what, $1.50 or something, maybe a little bit more. And so maybe I'll risk $2.50 to make possibly 40. That seems like a pretty good trade. Maybe I won't make 40. Maybe I'll make, cut it loose sooner than normal. Maybe I'll make 27. So I'm risking 2.5 to make 27. Maybe I'll sell half up 10 and keep half. So I sell half up 10 and half up 27. So I make, I don't know, 16 to 2.5. You get the idea, right? The chasm between what I'm risking and what I'm going to take, if I'm right, is huge. It's 5, 6, 8, 10 to 1. So those are the types of trades I want to put on. I'm not always going to get that, but that's what I'm trying to shoot for. So this name looks very interesting to me. And then some of my, GitLab, some of these newer names, they're very intriguing to me. I just wish there was a place to buy them. I've tried GitLab and it's just been really hard. Like I've tried there, tried here, and I just can't quite make it work because there's just no real base. So maybe it's getting close. This would be cool if this went sideways for a long, long time. Globe, another intriguing new name. You see, I just have to be realistic. As tempting as it is to buy that, it's just so beat up. It's just a bad weekly chart. And if I go and look at previous ones, they tend to go sideways for a long time before they come out. I don't know if it was Ring Central. When did it go public? Right after the crisis, maybe? I don't want to go back that far. No. So this is 23 down to 10. So 50%, a lot like, what I talked about. Runs up, breaks, runs up, goes sideways. Remember, this is a monthly chart and makes a new high this month, which is 228.27, 228.17. Sorry, bear with me here. There's a method to this. So, if I knew this company real well, like GitLab, I might be buying down in here and, trying to pick the low, but I would never survive this for sure. But that's 3 years before it breaks out. That would wear me out. No chance. I would lose my conviction and then it would run. And then I'd be like, wow, why don't I own Ring Central? Because I got wore out trying to get the perfect price rather than the right price. So you're better off, I think, I'll buy it there at 20, 23, and watch that move. Or, Team at Atlassian didn't quite correct quite as well, as much. Probably, but there's some corrections in there, and then that's the time to buy it. I remember buying Team right there that week, and this is a monthly chart. So you don't have to be the first one in. If this is real, I don't want to say which portfolio manager said it because I didn't hear him say it. One of the other portfolio managers of William O'Neill in a meeting said, so-and-so portfolio manager always says, if it's real, you don't have to be the first one in. And it's so true. If this is real, you could have bought Team at the very high that month and made a bloody fortune if you knew what you owned and had conviction and patience. 50 to 400, or Ring at the absolute high, or the absolute high 2 months later, or the absolute high 4 months later, and make tenfold on your money. So I have to fight that urge because I really want to buy some of these that are beaten down that I've made money in before. DLO is another one. This one I just couldn't resist. So I passed on Globe, I passed on GTLB, but I couldn't resist, and do own this one. But I think this one has a pattern. And now Pattern Break doesn't see it like that because there's no upper channel line. I'm sorry, a previous uptrend, but that's okay. I think that's possible. And again, I'm going to risk $1 to make $5 and see what happens. All right. So TJ is asking for the video. I'm doing this video much later than normal, and I'm I promised this would be a short one, and I just can't bring myself to do that. Okay, let's get into the quote of the week. All right, so it's from William O'Neill. Bull and bear markets don't end easily. It usually takes 2 or 3 tricky pullbacks, up or down, to fake out or shake out the few remaining speculators. After everyone has been run in or thrown in the towel, there isn't anyone left to take action in the same market direction. So I think that's a lot like what this market has done. Here's the NASDAQ, right? So, you know, if you got bearish, it made a new high, and you got bearish, it made a new high. And then you got bearish and it didn't make a new high, but the S&P did. You can see how tricky the top was, right? So this looks bad, make a new high. This looks bad, makes a new high. And it works in reverse. So NASDAQ, you've got a bad break, try to rally, fail, undercut, wave one. Or maybe this whole thing is wave one down, right? Because that's a pretty good rally right there. Then you undercut this low, and so now you have your second wave down. And then you rally, and now you undercut that low, and maybe this is the third one, which normally is enough. You know, a couple, 2, 3 waves down is enough to shake people out. So it's possible, based on kind of Bill's philosophy of 3 waves down, that you have that. You've got 1, 2, 3. Now this was very short, but it was nasty, right? Look at those bad breaks, gap down, gap down, gap down, and felt really bad. You know, it seemed like there was some forced selling in that spot. So maybe that's it. And we don't know. We don't have to know. We don't have to guess. Just play it day by day and try to keep those asymmetric trades on. You know, risk a little to make a lot. And if you get it right 3 or 4 times out of 10, you'll be golden. Last but not least, are a couple of things. We did introduce some new screens, and just in time, probably. A negative alert, which is a short sale screen idea, and Evel Knievel short sale screen alert, which is based on Tom Clogis's interview in Hedge Fund Market Wizards. He calls, you know, companies with high price to book and all of these things, they're you know, trying to jump the Grand Canyon. It's very, very difficult. Most of them will fail. And that's where I got the idea. And it's been pretty good this year. I've caught some, you know, really bad breaks in that screen setup. But, you know, maybe it's probably just in time for the bear market to be over. But anyways, now we have short sale screens if you're looking for them. And then ETF short-term strength, which will look for the best performing ETFs in the market. We cannot filter out the triple leveraged or the triple inverse or the double inverse. Unfortunately, I wish we could, because I wouldn't want to show those or give you the option to turn those off if you wanted. But, you know, if you run the screen, just keep in mind it's going to have some of those in there. So here's BERZ, which is, you know, the inverse of FANG, and it's 3 times. So be wary that, you know, what you're buying is 3 times the daily performance when you see that. Or here's a China ETF, which is China is really trying to put in some type of potential bottom as well. All right, so contact information. Marcus Smith at investors.com, 800-831-2525. Next week, Harold and Arnie, my colleagues, will do the Thursday afternoon monthly webinar, and I will be on vacation for a number of weeks. So there won't be any take on the market for at least 2 to 3 weeks. If something drastic changes, I'll have one of my colleagues do a video, but other than that, I won't be around and available to do the videos. Have a great weekend. Enjoy your summer, everyone. And thanks for your patience. Bye-bye.